One of the marquee reports of earnings season, Apple, that company posting an all-around solid third quarter, although China sales were weaker than expected. Everything else looked like it was incredibly strong, stronger than the street had been anticipating. Toni Sacconaghi is here. He's Bernstein's senior research analyst. And Tony, your take on this, I think you wrote something that said clean living. What did you mean?
Good morning, Becky. It was a solid quarter for Apple. The numbers were clean. They beat by a little bit, and they guided up modestly relative to expectations for next quarter. So there's been a lot of drama in tech land over the last several days. Apple doesn't fit into that category. They delivered slightly better than expectations and projected a pretty positive tone about the forthcoming iPhone cycle, which is really where investors are most focused.
We did mention that Apple's China business was down. I think it was down 6.5% year over year, maybe 10% sequentially. You want to put a little context around that?
Sure. So that was actually a little bit better than we had anticipated, Becky, because the last 3 years on average, Apple's been down about 16% sequentially. And so, yes, they were down handily year over year, but they did have a relatively tough comp. And we do believe at the margin, China was a little bit better. Now, all that said, there have been concerns that Apple may be structurally challenged in China. We don't believe that's the case. We believe that China consumers are very sensitive to feature functionality of the iPhone. This year, feature functionality was not particularly good on the iPhone in terms of improvement versus last year. And the Chinese consumer largely sat that out. We think that could potentially reverse next year.
You mentioned that Apple is very different from the other Magnificent Seven in terms of spending, what they're focusing on AI. They're actually cutting their CapEx. It's down 26% year to date. That's so different than we heard from, let's say, Amazon, where Andy Jassy says they're going to have to continue to spend pretty heavily on AI. And there's this big debate about whether that's the right play to be heavy spending now and hopefully build it up for when it's a bigger profit center down the road. What do you think of Apple's approach here?
Well, you're absolutely right. Apple's approach is highly differentiated, in part because it's a different kind of company. Apple is really an installed-based company. 1 billion consumers have their lives with Apple, their photographs, their notes, their calendars, their texts, etc. And what Apple is doing with AI is trying to bring the best of AI, so on-device AI, to help organize all those things, external AI with OpenAI, and bring that to its customers. It doesn't need to invent AI, and accordingly, it doesn't need to invest in large language models to the degree that others. It doesn't need to operate these data centers. What it's doing is providing access for others to bring their AI and for Apple to bring its own AI to consumers. And so the upshot is that Apple's going to spend maybe $10 billion on capital expenditures this year. Some of the other mega cap tech names that you mentioned, they're spending $50 to $70 billion this year. And as a result, Apple's cash flow is very, very strong because it doesn't have these huge capital expenditures.